This is the Daily Market Comment by Mario Hadjikyriacos. I'm Maria Pajardis. Thanks for joining us at xm.com. Global markets continue to dance to the tune of rising bond yields as a swift vaccination campaign and the overload of federal spending that is arriving soon have seen investors bring forward the timeline of Fed rate increases. The U.S. labor market is healing quickly. President Biden's gargantuan relief package has been approved by the Senate, and America has stepped up its immunization game, administering a record number of vaccines this weekend. Non-farm payrolls clocked in at 379,000 in February, pushing the unemployment rate slightly lower. Encouraging economic news is not always good for financial markets, though, as an improving outlook implies that the Fed might take the cheap money punch bowl away sooner. The Fed has promised to run the economy hot this time, but if the vaccinations and the trillions in spending deliver an unprecedented economic boom that lasts, normalizing rates could become appropriate before very long. This is what the bond market seems to be pricing in. The yield on 10-year treasuries is trading above 1.6% this week, with the first Fed rate increase being priced in for late 2022, early 2023. In the FX theater, the Fed repricing is a natural blessing for the dollar, as yield differentials widen in the reserve currency's favor. Indeed, the dollar is cruising higher against most of its rivals on Monday. The euro is particularly heavy, perhaps as traders position for a more dovish ECB this week. The exception is the British pound, which is even outperforming the dollar. The Bank of England has taken a similarly relaxed stance to the Fed lately. Policymakers view this as a natural reaction given Britain's lead in the global vaccination race. The euro and the yen might be in trouble in this rising yield environment, while the dollar and the pound could shine bright. Meanwhile, in the stock market, things are still shaky. Both the S&P 500 and the Nasdaq closed a very volatile session higher on Friday, drawing strength from the solid U.S. employment report, but futures point to another negative open on Wall Street today as higher yields take their toll. Finally, WTI oil prices hit their highest level in 2.5 years today after a missile attack against Saudi Arabia sparked fears of production disruptions. This was today's Daily Market Comment. Thanks for joining us at xm.com.